$64,000 is 4 times a $16,000 a year 401k payout. In this episode, I'm going to address a retirement plan that produces up to 4 times the income than a 401k. Get ready, because this could be significant for your retirement. So, my name's Doug Andrew, and I've helped many thousands of people optimize their financial assets, minimize unnecessary taxes, and empower their wealth so that they don't outlive their money. And I've discovered that a lot of people, especially in America, will outlive their money because they follow the herd. They put money in traditional IRAs and 401ks in the market, and then they lose a lot of their purchasing power or their income and outlive their money because of taxes, inflation, and market volatility. Now, when we talk about traditional IRAs and 401ks, so I'm going to share a story with you now about a gentleman who was actually a widower. He had just lost his wife when he was age 70 and a half. Now, I don't know if you realize that when you have money in a tax-deferred IRA or 401k, you don't actually have to start accessing money starting at age 59 and a half. You can without a 10% penalty. If you don't need the money, you're often told, oh, keep deferring, thinking that you're going to save tax. He had $600,000 accumulated in his IRAs and 401ks, but he didn't need the money because he had rental properties. And that was providing rental income, but you can put it off until you're age 70 and a half when this happened to him. Now it's age 72. At that age, you must start accessing money out of your IRAs and 401ks based upon the government's life expectancy formula. Now, let's just keep it simple. Let's say at age 70 and a half, your life expectancy is 20 years. That means you have to pull out 1/20th of your retirement nest egg, which would be 50 grand. If you don't, there's a 50% penalty, $25,000 penalty on top of the tax. The government will take 80 or 90% of what you should have pulled out. So a lot of people will take RMDs, required minimum distributions, which is the worst advice I've ever heard. Here's why. When he came to me, his $600,000 in the year 2000, he watched that $600,000 because it was in the market dwindle down in value to about $360,000 twice in that decade, 2001 to 2003, and it took 4 years to come back up to $600,000. In 2008, it went down to $360,000 again. It took another 4 years until 2012 to come back to break even at $600,000. This is why we call it the lost decade, or actually the lost 12 years. So he had it, but his advisor said, oh, hang in there. See, the market always comes back. Well, he had basically not earned anything in 12 years. He had the same $600,000 he had in the year 2000, and it was 2012. Pretty pathetic, right? What did his advisor tell him to do? Well, because the market's unpredictable, the industry standard is 4%. Take out 4%. It's called the 4% rule. Search this channel and you'll learn about what that is. 4% is what they want you to take out so you will not outlive your money, because most Americans with money in the market in retirement are only averaging about 3.5%. What's 4% on 600,000? 24,000 a year. That's pretty pathetic. He pulls out 24,000. He has to pay tax because he owns all this real estate. He's in a 33% combined federal and state income tax bracket. That's a third. What's a third of 24,000? 8,000. So he pulls out 24,000 a year, pays tax of 8,000, and has a net of 16,000 to buy gas and groceries and prescriptions, golf green fees. That's pretty pathetic. Okay? He's only really netting about 2.8% on his money. He came and visited us, and we said, get it out of there. Do a strategic rollout. I'm going to tell you what we did for him to 4 times his income on the same $600,000. Listen. So we performed what I call a strategic rollout. This is not a rollover. A rollover is like going from the frying pan into the fire, so to speak. That's where people take money in 401ks and roll it over to IRAs and continue to delay, postpone, procrastinate paying tax until they're age 70 and a half or age 72, and then they're duped into taking RMDs. Worst advice I've ever heard. In fact, people will say, well, how come they tell you to do that on CNBC? Who's funding CNBC? Government revenuers. Why would they ever want to kill a partnership where the government continues to get a third of everything you will ever earn for as long as you keep it there through your lifetime, your spouse's lifetime, and transfer down to your kids? That's called a stretch IRA. No. I said, get it out. Get the taxes over and done with in today's lower tax rates. You will not be sorry you did this. Ooh, I don't want to pay the tax. No, you will be glad you did. Here's what we then did strategically. We pulled out $150,000 a year out of the $600,000. While we were doing that, we managed it so he was earning actually 7.9%. So the $600,000, while we were getting the money out, was earning an extra $150,000. So we ended up getting $750,000 out because he kept earning interest, right? So $150,000 a year. Worst case scenario, every year we pull out $150,000 in a 33% bracket, he's got to pay $50,000 in tax. He's going to have to pay it sooner or later. If he did pay tax, $150,000 comes out, $50,000 goes to tax. He has a net of $100,000 to reposition. Remember, he didn't need the money. Where did he put it? He put that $100,000 a year into my favorite vehicle that's tax-free. It's called the Laser Fund. So we do that for 5 years. $100,000 net for 5 years. He's got $500,000 in his Laser Fund. It's totally tax-free. Now the Laser Fund has been earning 8% and even a little north of 10%. So $500,000 at 8% is $40,000 a year tax-free. Is that better than $16,000 after tax on his IRAs? Yep. He's actually been earning more like 10.07. 10% on $500,000 is $50,000 tax-free. But wait a minute. At the beginning of this episode, I said 4 times. Oh, okay, I'll deliver on that. I mean, would double be enough? Triple? But we quadrupled his cash flow. Here's how. So before I share how we were able to get $750,000 out of his IRAs and 401ks with no tax consequence, if this is intriguing you, I would encourage you, click like, share with somebody who really ought to learn this, and feel free to make a comment. Subscribe, click the bell so that you can be notified every time I post an in-depth answer to a financial question, which I do almost on a daily basis. Now, what we did for this gentleman is every year that we took out $150,000 out of his IRAs and 401ks, it showed up on the front of his 1040 tax return, right? You have to report it. Now, instead of having to pay tax on that $150,000, we actually resurrected new deductions, tax deductions that he had sort of been killing for the last several years. He owned a lot of real estate properties, rental duplexes and fourplexes. He thought the best thing to do was to take all the rental income and hurry and pay them off. I said, well, let me teach you how money really works. He had tons of equity in these properties. He refinanced them. In the Internal Revenue Code, he can deduct the interest on the mortgage. He goes, well, why would I mortgage these rental properties? I said, well, you're only achieving a portion of what you could do. The third marvel of wealth accumulation is safe, positive leverage. He goes, well, I understand leverage. I said, yeah, but see, you want leverage with liquidity. You have no liquidity. If something happens and they all become vacant and you can't even make a mortgage payment, all the equity is trapped in the property, you can't get it out. It's the hardest to get when you need it the most, okay? So we refinanced his properties and put the equity out of those rental properties over into my favorite financial vehicle, the Laser Fund, and that's very liquid. Now the Laser Fund has been earning for him 9 and 10%. Let's just say 9% tax-free. The mortgages on the rental properties were at 4.5%. 4.5% tax deductible in a 33% bracket is only a net of 3. So every $1 million that he borrowed on rental properties, He pays $45,000 a year in mortgage interest, but that's deductible on his Schedule E or his LLCs, however he owns those properties. So he's really only shelling out $30,000 for every million. $30,000, he's making $90,000 more on the equity he pulled out. How much more is $90,000 than $30,000? 300% more. Would you hire an employee for $30,000 that made you an extra $90,000? Would you hire employees for that? Would you even buy a widget machine that made you 3 times what it costs? See, that's a 300% return on employment cost or equipment cost. So he was making so much money, he goes, my heavens, Doug, what am I going to do with all this money? What was the byproduct of resurrecting deductions that he had been killing by paying it off? He was able to offset the $150,000 as it showed up on the front of his 1040 tax return with new interest deductions. So he could pull out $150,000, he offset that with new deductions, and he was able to use the entire $150,000 because he did not have to pay tax on his 401k withdrawals. In 5 years, we didn't end up with $500,000 after tax in his laser fund. We ended up with the full $750,000. $750,000, he's been earning, let's say, an average of 8.5%. That's $64,000 a year. How much more is $64,000 than the $16,000 he was getting out of his IRAs and 401ks? 4 times. You can do this. Let me show you what you need to do next. So just like this gentleman, when he got his ahas, his epiphanies, and we were able to increase his retirement income on the same asset by 4 times. By doing what? A strategic rollout. It's simply a 3-part strategy. We got the money out of his IRAs or 401ks in 5 years. Got the taxes over and done with in today's lower brackets. Even if we had paid the full tax, he would have had $500,000 in what I call my favorite vehicle, the laser fund, generating between $40,000 and $50,000 a year of tax-free income instead of the $16,000. But I help people optimize assets. I couldn't rest. I go, you know what? If I were in your shoes, I would resurrect some of the tax deductions you've been killing, and we'll get the money out of your IRAs or 401ks with no tax, which we did. So now he has $750,000, not $500,000, that generates 4 times what he was netting on the same amount of money in his IRAs and 401ks. If you would like to study this example and several more, I have a chapter dedicated to that topic on this side of the book. What? There's 2 books in one. See, this side talks about the laser fund, how to accumulate, access, and transfer your money totally tax-free for these types of strategies for retirement and so forth, tax reduction. If you learn more from the stories like the one I just told you, then I would recommend you flip it over and read this book. This one has 62 stories just like the one I told you that will empower you to understand this better. How to harness the 3 marvels of wealth accumulation: compound interest, tax-free accumulation, and safe positive leverage. The ability to own and control assets with very little or none of your money tied up or at risk in that asset. But remember, leverage without liquidity is stupidity. You'll learn why. Go to laserfund.com, L-A-S-E-R fund.com, contribute a nominal amount toward the shipping and handling. I'll cover the rest of that, and I'll pay for the book and send out a copy of this to you. There's options there to listen and learn, watch and learn, but I'm passionate about providing you with insights into opportunities that maybe you never knew existed before. So enjoy.